You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back here in the Chicago studio holding court on yet another Education Wednesday. Yes, it is time for Options Bootcamp, the premier options educational program. My name, of course, Mark Longo from theoptionsinsider.com, as well as from this little thing we like to call the Options Insider Radio Network, upon which so many of you are mainlining these days. Hope you're having a good time. Hope you're enjoying all the content out there. If you like podcasts, if you like options, and you're not subscribed to the full network, what the hell are you doing? Do you have a commute? Do you work out? Do you have any time you like to listen to audio content? Man, we got you covered going back 16 plus years worth of options goodness. You will have stuff to listen to, we guarantee you, and most of it will be pretty darn good, except for the stuff with that pass early guy. We can't really speak for that. But the rest of it, all top-notch quality content, of course. Make sure you subscribe to the full network if you're not on whatever platform you're listening to this to. And then on that platform, if you like what you hear, throw some stars or a like or a review, whatever your platform lets you do. It does help new people continue to discover the show. Like this week's 5-star review coming from Apple Podcasts. This comes from Denmark. This comes from ASDDA193DK. Say that 5 times fast. In Denmark, he said, this is 5 stars, great value. He says, very much value in this podcast. I'm not far yet in the podcast, but I am studying, I think he means this subject in finance. So I have a basic understanding. The way you guys describe derivatives are very intuitive and should absolutely be a part of the way you get derivatives knowledge. Good job, guys. Well, thank you, Mr. or Mrs. ASDDA193DK from Denmark. We love all of our fans, including our overseas fans. In fact, Dan, I believe, going to do that tour of Oktoberfest with one of our international listeners a little bit later in the year. Speaking of Dan, I am, of course, referring to the black hat who won himself, Mr. Dan Passarelli from Market Taker Mentoring. Mr. P, welcome back to the show. And what do you think of this international love, this time from Denmark, sir? He says we should be part of the way people learn about derivatives.
You know, I like it and really appreciate it. Thank you so much for the kind comment. You guys have pretty good hot dogs over there in Denmark. That's, basically my main experience with Denmark is the hot dogs, street food, as well as we went to a Michelin green starred restaurant as a vegan restaurant, and I am not a vegan by any stretch of the imagination, but holy cow, that place was fantastic. Oh my gosh. If anybody's interested in the name, I'll hunt it down for you. I forget. It was about a year ago. But
yeah, I haven't spent much time with the Danes. I'll have to go check it out. Is that where, didn't one of your kids go to school there?
Yeah. Isabel spent a semester there. So we,
So you're pretty familiar with the Danes.
Yeah, man. Yeah.
It's not just Hamlet. A lot more to the Danes than Hamlet, including some options love. So thank you there, ASDDA193DK. If you like what you hear, throw some reviews our way. It does help new people to continue to discover the show. We have hundreds of reviews, but we also have hundreds of episodes. We like to have at least as many reviews as we do episodes. So get in there, leave some stars if you like what you hear, as we keep on rolling into a little bit of the old options drills.
Colin Boots. Time for our favorite pastime, option drills. We're going to take the strategies learned during the show and teach you how they can be employed to achieve a specific objective. Do you hear me? Yes, sir!
All right, everybody, welcome to some options drills. This show always resonates a little bit more in July, Dan, because the music, the transition is so patriotic. If it's not 4th of July, even when we're recording, let's say, in the depths of frozen January here around Chicago, it still feels like the 4th of July whenever we record this show. Dan, don't you agree?
Oh, yeah. It's very festive music, Mark. I love it.
Dan's always letting off fireworks in the background, you know. He's just having a good old time here on the show. Our listeners from Denmark may not get what all that it means, but it's fun for us here in the States. And it's fun for hopefully all you folks around the world as well. Welcome to some options drills. Going to do something a little bit different today because we talk a lot about different strategies and how you could use them and how you could trade this and trade that. But we get it. A lot of you out there are pretty busy folks. You're pretty accomplished. You have decent jobs. You have lives. You have families. You have things you want to do outside of trading. So you do not have time, perhaps, to be at your screens all day babysitting your bleeding edge 0-day aggressive strategy out there. So we get it. We get it. We hear from you folks all the time. Man, I love this stuff you're talking about, but I really don't have time to babysit this stuff. I'm away from my screens most of the day. I'm doing something. Who knows? You're a doctor, you're a teacher, whatever you are. You can't be sitting at your screens all day. You have to go do surgery, you have to teach kids, whatever it is. We get it. So you know what, Dan? Today's episode is going to be for those folks, the busy folks who don't have time to babysit all of their trades. You know, I hate to use this phrase because I don't like the connotation for it. It comes from an infomercial, so that's part of the problem. But dare I say it, the more set it and forget it type approach to options trading out there. Mr. Dan, I'm sure you've encountered this all the time over there at MTM. People come to you, they say, Dan, I like all this cool stuff you're teaching me, but I don't have time to do all this stuff. What do you typically counsel those people, and what do you say to people who are looking for some cool options, things they could do in their portfolio, but they can't be at their screens all day, sir? What's your first response to them?
Yeah, this is really a thing that that we come across with a relevant percentage of our student traders, and a lot of times what we do is we work through it in one-on-one coaching, because there's different degrees to set it and forget it. Like I had one guy who was an airline pilot who would fly to Korea. And he was weeks on, weeks off, whatever. So it's just couldn't trade or had to be ultimately set it and forget it, And
he wasn't slinging straddles mid-flight, just hey, you take the controls, Bob. I got to close out my straddle position here.
yeah, exactly. And then, there's some people who have, who can check stuff on lunch, and had one guy who, worked up on telephone poles, So, it's something that we devise specific plans for our one-on-one coaching students. And then, people who aren't in one-on-one coaching, I guide them towards specific offerings that we have that are better for people who have busy schedules that can only check intermittently. Some things like our earnings trading system, you can do if you have a busy schedule, but it's better if you're able to check it at will. But then our credit spread genius and that kind of thing, hey, man, if you can check it once a day, you're good,
Yeah, that's the ironic part of options trading. A lot of people have stocks. You can buy a stock and just let it sit in your portfolio for years. That's kind of almost the definition of kind of set it and forget it type trading out there. Options, shall we say, that they attract a little bit more successful audience. It's an interesting side effect of the product. People come to options trading who are usually pretty successful in other walks of life. So almost by definition, they have less time than people to trade these things. And on top of that, these are more demanding products. So it's an interesting Venn diagram that we're working with here. Let's get to some of the most basic, most set it and forget it. And again, I hate that terminology, but we're trying to approach it here for you guys on the show. Types of trades you can employ in your trading. Dan, the first thing I think of when people ask me this type of question, they say, what's a good strategy I could put on? I could put it on and I could come back to it a week from now, a couple of weeks from now, maybe even a month or two from now, and just see how it worked out. And the first thing I think of when I think of that scenario, and there's two really that come to mind, and they're both kind of different sides of the same coin. We'll start with the cash secured put. We've talked about these before, listeners. XYZ trading for $100. You're interested in buying, let's say, 1,000 shares. You like this stock. If it drops to 90 sometime in the next couple of months, let's say, you can always go out and just work your limit order to buy the stock. If it hits 90, you got the stock. If not, nothing happens. But you also don't get any compensation for the risk you take, which, as we've all learned over the last few years, working any kind of stub quotes like that, you can get hit in some dramatic whipsaws, and there's risk there, and you're not being compensated for it. Or you can be compensated for it. You turn around. In our case, we're going to sell the 1 month option. You can go out a little bit farther if you need even more time. I tend to like a little bit nearer dated stuff because you can adjust, and also you're maximizing the theta decay on these elements. But again, this is for the busy people who don't have time to get in there and really micromanage their position. So in our example, you sell a 10 lot of the 1 month out 90 strike put. In our example, you get $1 for that. So remember, every contract is for 100 shares of the underlying. So 1 times 100 times 10, because you sold 10 contracts, you're collecting a whopping $1,000. That's your payment for the risk you are taking. It's up to you to decide if it's worth it or not. It's certainly a heck of a lot better than the nothing you're getting for working the stock order. And then because this is cash secured, we're going to do set it and forget it. You have to set aside the capital to buy this stock in your brokerage account. How that is calculated, we've done a whole episode on that, listeners. So go check that out in our archives. But this is not a free lunch. There is an opportunity cost to this. How brokers calculate it varies. Could be 20% of the underlying price minus the out of the money plus the option premium. A lot of different formulas they use. 10% of the strike price plus the option premium, all these other things. There's different ways they calculate the amount of margin, but there is going to be an opportunity cost to this. So again, you have to weigh all those factors, the amount of premium you're collecting. Is that the strike where you really want to buy the stock? And also how much capital you have to set aside for doing this. But in our case, you do that. You set aside your funds. If nothing happens, the stock just drifts. You're keeping $1,000. If the stock drops, you got $1 for that put, so you're buying the stock at the effective price of $89. So that's a great set it and again, I hate that term, but that's what people like to say because you should check in on this every now and then, see how it's going. But you could come in at the end of the trade a month from now and say, oh, it looks like I bought the stock and the stock is here now. Or you could say, hey, I collected $1,000. Maybe I want to do it again. And so that's one way to go about that. The other side of that, as I said, the flip side of that, with very much two sides of the same coin, these strategies. For a lot of people, they already have equity in their position. So a covered call is another great example of a, let's forget the set it and forget it, the low babysit factor type of trade out here. Again, XYZ trading at $100. You're long, let's say 1,000 shares from $70. You're sitting on some profit in our example. You think the stock's going to hang out for a while, not going to do much, but you don't really want to sell it, maybe tax purposes, whatever the case may be. So you decide to sell a covered call. In this case, you say, you know, if the stock gets up to about 110, I'm good selling it. That's $40 in my pocket at the end of the day. I'm good with that. So you sell a 1 month covered call. In this case, $1. Again, same math. You're going to collect $1,000. 1 times 100 times 10. So now your stock sits there for the next month, doesn't do much. You made $1,000. Not bad. You made $1 on 100, 1%. It's not blowing the world away, but it's not nothing either. And you keep doing that over and over again, hey, you're good. And maybe the stock rallies, you sold the stock at a level you're comfortable with. You come back in a few weeks, a month from now, you check it and you say, oh, this is looking pretty good, or, oh, my stock got called away. Interesting. You know, you could kind of check it in that sense. And so in that sense, those are my two go-tos in terms of, again, the term I dislike, the set it and forget it type trades. What are your thoughts on those for these busy options traders don't have time to check their screens all the time, sir?
Yeah, those would be ones that come to my mind too. And I like all the things that you had to say, but I want to take it yet a step further. I think under the right circumstance, it's not only okay to trade these as, set or forget or low babysitting. I kind of like that one. Trades. But under some circumstances, you'll probably end up trading them better if you treat them as, hey, I'm going to put these on and see what happened in a month. It depends on your objective, and we've talked quite a bit about this on the show in the past, but I think it's been a bit. I'll do a little bit of a refresher of sort of the market taker take on it, which we're actually revamping our class on covered calls and cash secured puts. That should be ready in about a month, I hope, if I can get my butt in gear. But there's basically two objectives that you could have trading a cash secured put or a covered call, because like Mark pointed out, they're basically two sides of the same thing. One is, skate or trade. One is to hope to skate, basically sell the put or call and hope to skate on it, meaning, hey, I'm just going to keep the premium and do it again. Or trade, as in trade out of the stock, or into the stock. If I sell a cash secured put, I'm not just okay with getting assigned. I literally want to get assigned. And when that's your objective, man, just putting it on and saying, I'm not even going to look at this until, the Saturday, 24 hours after expiration, because I don't even want to let anything get in my head. I know what my plan is. I would kind of like to get assigned on this. And I'm not going to allow myself to run away if it gets close and put in those cancel of close orders. And so, yeah, it can literally be beneficial sometimes to set it and forget it and just let nature take its course with the trade.
Yeah, a lot to unpack on this topic here, listeners. And some strategies kind of mix both worlds. As you notice, both of the strategies we started with are short premium type strategies, because those are kind of very specific endpoints people can wrap their heads around. Say, hey, I'm collecting this. If the stock gets to here, this is what happens to my position. And if not, I get decay every day. A little bit of decay working in your favor every day is not a bad thing when you can't pay attention to it all the time. The flip side of that, the long premium, things get a little bit more challenging because, as we'd mentioned before, you have that decay factor working against you now. The options die a little bit every day. That death factor is kicking in every day. It kind of has that aggressive ticking clock where you really need something to happen very near term in that options lifespan for those types of trades to pay off. So you kind of need to be babysitting those a little more. Dan, where do you fall on a trade or a strategy that kind of combines the two, the collar? Obviously, a collar, listeners, let's go back to XYZ. It combines the covered call, but this time with a long put, not a short put. XYZ trading at 100, you're maybe a little bit dubious about the downside in the near term. You own it at 100. You decide to buy a 1 month put, the 95 strike put. So pretty tight protection for $1 in our example. So you're stopping yourself out at an effective price of $94. Maybe you don't want to pay all that. Maybe you don't mind selling some of the stock a little bit higher. So you also sell a 1 month 105 strike call in our example. This time you get 25 cents. Remember, in reality, the call is going to be worth less than the puts in most of these equities you're trading. So we're trying to keep this example a little bit more real world for you out there. So now instead of paying $1 for that put, your net outlay is 75 cents. You can see the initial benefit. Of course, you reduced your outlay. But Dan, the challenge now is you have a long premium position on top of this. So that makes it maybe a little bit more difficult for these set it and forget. I think if I was going to do this, I would probably add a short put kicker to this. So I'd probably buy the put spread. So maybe buy the 95 put and maybe, in our example, sell the 90 strike put for, let's say, 50 cents. And now your outlay is only 25 cents. And you've got a little bit more, not quite set it and forget it, but a defined risk type approach. It also helps offset some of the cost and the danger of that long premium position. But where does a collar fall for you, sir, in the set it and forget it pantheon?
Well, collars are a little trickier. I mean, you look up what a collar is on a website or in a book or something like that. And, you get the textbook education of it, and it sounds pretty simple and straightforward, where you could just set and forget it. But in reality, it seldom is, because a lot of times people collaring these positions. I mean, like, look, if you're that worried about a stock falling, I mean, you could sell it, right? I mean, really, the whole purpose of it is to buy a put, but to finance it by selling the call. And a lot of times people who are using these collars have what I would call concentrated wealth positions, meaning like maybe they worked at that company in a higher level position and they have a concentrated amount of their personal wealth in that stock, and maybe they're not allowed to sell that stock. And so they don't want to end up, a lot of times they don't want to end up in a situation where the call gets assigned and they sell the stock, because then it's a mess. So a lot of times you really need to monitor these trades a little bit more and get a little bit fancier with them. I know it's probably been a couple of years since we talked about the split time collar, which is something that I teach my usually consulting people who I consult about concentrated wealth positions about how to do that. So I don't know, it can be a little bit trickier, but if you're okay looking at it and saying, yeah, I own this stock here, if it goes higher, man, I'm just happy to sell it. If it goes lower, I'm happy to have myself protected. Then, hey, man, sure. Yeah. Put on a textbook collar and great. And then you can not babysit the darn thing.
Let's get into some more exotic type positions. Some of these could be debatable whether they are set it and forget it. So I want to get your thoughts on these, Dan, as well. Let's go out to, again, the options kind of 201, maybe the option 301 type strategy. The time spread, the calendar spread, call it what you will. Is this a set it and forget it type strategy? I think it's kind of debatable whether it is or not. I think if you take that approach, you can really only do it through the expiration of the first leg. Beyond that, you're going to have to make a choice one way or the other. So maybe set it and forget. Let's break it down and see what we think, listeners. Let's go back to XYZ. This time it's only trading for $20. You think maybe the stock's going to hang out for the next month or so. You go out 2 months. You buy the XYZ 2-month at the money call, trading $2 in our example. And then you sell against it the 1 month, the front month at the money call as well. In our example, that's trading for $1. What have you done? You've bought now this long time spread, this long calendar spread. Your net outlay, your net risk on this trade is $1. Now, what makes this set it and forget it? Because if the stock hangs out or closes, right around $20 at expiration, that short call you sold is going to expire worthless, and you're left holding the bag on this 1 month call that you bought now, because it's going to be 1 month because the front month expiring, so that's rolled to the front month position now, and you paid only $1 for it. So you have to decide what you want to do at that point, whether you want to hold the position and let it ride. That's why it's not entirely a set it and forget it. Maybe you need to make two choices with this trade. This is the type of trade you put on when you don't expect a lot to happen. And then once that first expiration happens, you can decide whether you want to take the whole thing off or maybe let the dice fly on that second leg. But then again, you have a long premium trade after that. And those need a little bit more management. Dan, where do you fall on the time spread as a set it and forget it type trade?
And I just want to make sure that I'm clear on that, Mark. So this is it's just a straight time spread. It's not also
nothing fancy, just a straight at the money time spread.
Oh, yeah. So basically a call time spread on something that, and you would do it a little bit out of the money thinking that the stock's going to go up, basically just financing the long call by trying to skate on the short call. Yeah.
Exactly.
Yeah, I mean, I think that has its place in the stable of option strategies. It becomes an interesting one there because there's timing issues. I think maybe if you own, a fairly long-term call, at least 6 months, and your plan is maybe to, use it to acquire the stock, just as a low-risk way of acquiring stock, which I will do occasionally in like my IRA. But then you're in a period where the market's looking a little bit weak, or that stock's looking a little bit weak. It might make sense just to go in there and, to me, roll that into a temporary calendar just to be able to take in some of that option premium, thinking that in the short term, the stock's not going to rise to that level. And then that just P&Ls against your long option and basically should more than cover the amount of theta that you would lose holding that long option. So, yeah, I mean, that's just one example that comes to mind where that could be a very strategic way to do it. Yeah.
You know what I used to think of, let's say 5 or 6 years ago when people asked this question, outside of the short put and the covered call, one of the more exotic, lesser known, set it and forget it type strategies that really perform very well over time. Again, going out to the world of the volatility products now, listeners, the volatility ETPs, the exchange traded products. So your ETFs, your ETNs, all that fun out there. So your VXXs, your UVIXs, your UVXYs, what do all these products have in common, listeners? They're attempting to replicate some sort of long volatility futures position. Whenever you do that, you have that roll yield, in this case, negative roll yield, which ends up being a drag on these positions. If you're not sure what the hell we're talking about, go check out some of our volatility-themed episodes of this show, or go check out our show on this network called Volatility Views, where we talk about this all the time. That's one of the most popular trades in the volatility space, is fading these products over the long term because they erode so steadily week after week and month after month. For a long time, the long-term, let's say January, out-of-the-money puts in these names, let's say VXX or UVIX or UVXY, after they reverse split, which they usually do because these underlyings tend to erode. Once they get below 10 or around $5, they tend to reverse split them. In the case of UVXY, they just reverse split it back up to about $20. VXX reverse split back up to about $40. So you're in a decent time to be looking at these strategies right now because many of them just reverse split. Gives you a little bit more juice to the downside. People will often come in after those reverse splits. Let's say VXX reverse splits to 40. Maybe they go out a year. They buy, let's say, after their analysis, they decide they want to buy the 20 put. Maybe they pay $1 for that a year or so out. They load up on some of those, and they put those in their portfolio for a rainy day, and they wait. They wait for VXX to decay and for those puts to potentially cash in pretty big. This used to be a great trade. It was kind of an unheralded trade. That's why I say in the last 5 or 6 years, I've kind of changed this a little bit because this trade has become more crowded. People have gotten more sophisticated. They tend to be a little bit more nuanced on this trade. So you're seeing more people lining up on these strikes than you're used to. And also these products around January, it all comes down to what happens really around that, let's say in this example, January expiration, because we've seen crazy things happen just about every January for the last few years. Something happens to all of a sudden, let's say you had that nice juicy VXX eroded from 40 all the way down to, let's say, 17, 16, 15. You got nice juice on that put you bought. And then all of a sudden something happens back in 2020. Of course, we assassinated that Iranian general on the runway. Everyone forgets about that before the pandemic spike of vol happened. We started seeing vol kick in as a result of that. Of course, January 6th, a year later, all these crazy things have happened in January that have caused vol to pop. And all of a sudden, this great trade you had in your back pocket, all that premium, all that money you made vanishes as the underlying pops and you're done. It could be a heartbreaker, these trades as well, which is why I only caution these for people who are very savvy, who understand the vol market, who understand exactly what we're talking about in terms of decay, have a way to go out and kind of calculate that theoretical decay on these products. But if you're comfortable with that, this can still be a very potentially profitable long-term set it and forget it type trade. I would just caution you when it gets close to expiration, gets into that front month of January where your puts are now, again, the front month option, you probably want to pay a little bit of attention to it then. You've ignored it for months. Now that last month, you probably have to decide when you want to start taking these off because you don't want to leave yourself open to having something happen in the last minute. And it's happened a lot. Trust me. Something happened in the last minute to wipe out all of the value you have in these puts. But Dan, for a long time, this was my go-to. And people ask me this. If they were a little bit savvy, I would say, okay, this is your trade you want to do. You want to go out and buy whatever it is, 50% out of the money, whatever the case may be, long-term puts and your VXXs, your UVIXs, your UVXYs, and then just set it and forget it. Let it make money for you. These days, it's a little bit more challenging. But what do you think about this strategy as a long-term set it and forget it type approach, Dan?
Yeah, I do like that. It's interesting. You're playing a couple of different things that are strategic on that. It's funny. I have not really played anything in the volatility complex since, geez, man, it's been a while since that one debacle in VXX where they weren't, what's the word I'm looking for? When VXX broke.
The Volmageddon back in 2018?
Yeah. No, couldn't have been that long.
Oh, the more recent VXX. That was just last year, yeah.
Yeah, just last year. Right. So, yeah, I walked away from it and I just never looked back, which, I think might have been a common thing, because that's when, we were down at our mastermind at the Chicago Board Options Exchange. We took our mastermind members on a tour of the new CBOE trading floor. And, the guy who was kind enough to be leading our tour, he was like, oh, yeah, just VIX volume has been really down, the past several months. And I got to believe that it had a lot to do with VXX breaking. Just a lot of people just sort of walked away and didn't walk back. But I don't know, maybe people have been. I haven't. Maybe it's something I ought to look into. But
yeah, I did wash my hands of VXX last year, and then Barclays has recommitted to the product. So bear that in mind. There are some issues. That's why I say you have to be savvy and a little bit sophisticated in the space. But there are many people, Dan. This is the only trade that they do. They don't get long SPY. They just trade vol decay over and over. Our friend, Mr. Once and Future Dr. VIX, Mr. Rhodes, this is kind of all he does. He's long a ton of SVIX. He actually plays the decay the other way. He buys SVIX. There's many ways you can do it. But this vol decay, it is a predictable enough trade that many people out there in the vol space, this is what they do day to day. They trade for vol decay. They don't go for anything else. They're not buying stocks looking for the pop. They're going for their predictable vol decay over and over again. So if you can become savvy enough in this space, listeners, this can be your trade. This could be it. But again, it takes a little bit of nuance, a little bit of sophistication. But it's one I encourage you to check out, even if it is a little bit more crowded than it used to be. Dan, we've hit on a bunch of potential set it and forget it, some better than others and some a little bit more sophisticated than others. Are there any we left out that you can think of that would really be great? You're a busy person. You're the doctor. You're the teacher. You're lawyer, whatever it is. You don't have time to babysit it. What are some go-tos that we left out?
Well, there's a middle ground. There's sort of like the the preteen that you leave at home without a babysitter, but have to keep checking in on every now and then.
Preteen, I'm terrified of those. Preteens are terrifying. I have one, and yeah, they're not fun.
Yeah, it's the gift that keeps on giving, Mark. Yeah, so things like, well, a lot of folks who have some of those jobs where they're able to check in on things, like you can make things sort of those preteen not really babysit but keep an eye on by setting alerts on stuff. And you can do this with credit spreads, anything that basically has a quantified break even. I mean, even time spreads where the break evens are just sort of modeled out. What I'll do is I'll set alerts. Hey, if the stock goes through the short strike price, ping me on my phone, and then I'll see it and I'll be like, oh, yep, I got to go deal with this. And, I'm always in front of my computer, but, just in theory, I would see the alert. I would walk over to my computer and deal with it, and then done, just sort of like calling that 12-year-old and saying, is everything okay? You burned the house down yet? No? Okay, good.
I like that. Preteen option strategies. Both terrifying and annoying at the same time, but potentially good in the long run. Before we get out of here on this topic, Dan, I want to touch on some trades and strategies you should definitely avoid if you are a busy options trader. Now, Dan, I'd be curious to get your thoughts. When I think of this, when people ask me, what is the one strategy you should definitely avoid if you're a set it and forget it type, I almost gave it away. It's a Freudian slip. A set it and forget it type trader. I think straddles, first and foremost, particularly the long straddle out there. This is, to me, the mother of all anti-set it and forget it type strategies. These strategies require the most babysitting. They require the most active management. If you're going to sling long straddles, then you better be able to be glued to your screens, Dan, because you might sometimes need to take these off piecemeal. Maybe you want a gamma scalp against it or leg into other trades against it. They require a lot of babysitting, a lot of hand-holding, and these are not for the faint of heart. Would you concur, sir? Straddles, not a good set-it-and-forget-it strategy.
Yeah, that would be the one that comes to mind for me too. I mean, there's a few different techniques for trading straddles. The ones where you're trading a break-even straddle, like not break-even as in profit break-even, but like where you're looking for the stock just to go through the at expiration break-evens, and that's like your game plan. They're as close to set it and forget it as you can, but like you still got to set lots of different types of alerts with that too. One being just like, set a reminder on your phone for 4 days from now, and if you don't have a profit, get the heck out. But then you have to put profit taking limits in there too, and they might change with time as theta comes out of it. So yeah, I mean they're very, very difficult to do set it and forget it for sure. Yeah, anti-set it and forget it for sure.
And then other long premium type trades, they fall into different areas of the pantheon of set it and forget it here. Like your typical long puts and your long calls, you can trade those with a minimum of effort. It just requires some effort at the outset of the trade. If you buy a call, for example, you should set a stop loss where if this thing doesn't work out the way you want it to, where you could keep some of your money there, unless you want to let the whole thing fly. It's up to you, unless you're buying those out of the money lottery tickets. You should also have some sort of profit goal where maybe you're going to start taking these things off. Maybe you'll take half of them off at this level and then the rest off at this level if it hits those. And then at least you've done that diligence at the outset. And then you can somewhat set it and forget it. I still do caution you if you're doing a lot of long premium. You want to kind of keep an eye on these because things can happen, decay can kick in, and all of a sudden maybe you're surprised at what you have that you're holding on to. So you may have to step in before those stops or those levels are triggered and do something. So maybe planned on checking on these, let's say, a little bit more frequently than some of the other trades that we just talked about. Other things out there, your iron condors, your butterflies. You have your premium outlay at the front of the trade. You know how much you're paying. You know where your profits and losses are. But they have multiple legs, so they do require a lot more management. An iron condor, maybe, let's say your stock rallies, you take off one leg, and then it drops, you take off the other leg. So there is some babysitting involved in those. A butterfly, same thing. You can end up taking it off piecemeal. So I would put those in the not exactly favorable to set it and forget it category either. And other things to look at. Oh, in general, Dan, I would say some products you may want to avoid. I would say definitely, all we talk about on this network a lot these days is 0 day. Everyone's fixated on that. If you're a busy person throughout the day, you can't check your screens, 0 day is not for you. Stick with, at the longest, or shortest, I should say, really, is probably in the weeklies. If you want to write a covered call for 1 week or sell a cash secured put for 1 week, that's fine. You can come back and check it again a few days later, maybe at the end of that day if you have time after you're done whatever it is you do during the day. But the intraday, 0 day stuff is going to be very challenging. Those are for the people who really can be glued to their screens throughout the day, because look what the markets we have. They're whipsawing all over the place. If you have some crazy strategy on, you need to be there to potentially take it off or be ready for when the worst case happens. So I would definitely caution against 0 day. Dan, do you concur with that? And are there any other products or strategies that you counsel people to avoid if they are busy in their day jobs?
Yeah, I mean, generally speaking, the 0 days are definitely also an anti-set it and forget it. Even when the plan is to set it and forget it in some ways, because I had a strategy. It was actually like a 1 day trade. I'd put it on the last half hour of the day, and then it would expire the next day. And my plan was to let it expire. It was one of the very rare strategies where my plan is to let it expire. And I remember this one time I got on a plane, like I had the thing on in the morning, got on the plane before the open, and it was a long flight, like a 4.5-hour flight. Is going like Vegas or California or something. And I get off the plane. It was after the market closed. And I'm like, oh, what the hell just happened here? It's like, well, that didn't work. So I guess if I was at my computer, I probably could have done some damage control. So yeah, not super good for set it and forget it.
All right, Mr. P, that music means we've come to the end of our set it and forget it discussion for this week. Are you a busy trader out there? Have you found a strategy that you like, maybe a product that you like, and you want to discuss with us? Maybe you have different views on some of the strategies we laid out here. We want to hear from you. Easy to find us at Options on most major social media platforms. We are Options Insider on that new Threads platform out there, just because they keep us with our Facebook branding, so we couldn't get at Options there. Unfortunately, we're at Options on just about everything else. Questions at theoptionsinsider.com also works if you want to get a hold of us here on the show. You can, of course, leave reviews like we said at the top of the show. Just try to avoid asking questions in those reviews, because we tend not to get to those in a very timely manner. As you can see, some of these reviews we get to could be a year or two later. So we have a lot of platforms we have to manage here, listeners. So those other ways, the email, the social media, the best ways to get at us quickly with a question or a comment about the show. And Mr. Dan, before we go, if they want to get at you quickly, where should they go? What should they do?
Well, you always know where to find me, guys. I'm predictable. MarketTaker.com, 2 T's in a row. The second theta is for T. No, second T is for theta. I love interacting with our Options Bootcamp listeners. So, yeah, hop on over. Send me a message. We'll chat.
There you go, MarketTaker.com. The second T is, of course, for theta. That's going to do it for us here on the live today. Back again tomorrow, noon Central, 1 p.m. Eastern, for a little bit of the old OB. After that, with our buddy, Mr. Dan Gramza, talking all things futures options on TWIFO. Back again on Friday, of course, noon Central, 1 p.m. Eastern. If you like that vol talk we had today and decay and all that fun stuff, and you're stroking your chin, you want to learn more, check out Volatility Views. It goes live noon Central, 1 p.m. Eastern every Friday. After that, I should say, for all of you pro folks out there, you get Options Oddities. And back again next Education Wednesday, another episode of Options Bootcamp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.